This is Nightly Business Report with Tyler Matheson and Susie Guerin.
Markets rattled, the Dow dips, bond prices rise as the conflict between Russia and Ukraine enters a new phase. What's next for stocks and bonds, and what's your best move now?
Food for thought. The once hot, fast, casual dining sector may be starting to falter, but there's one company that's standing out from the rest.
All revved up. Why the value of collectible cars is accelerating fast. All that and more tonight on Nightly Business Report for Friday, August 15th.
Good evening, everyone. Until today, it looked like the stock market was set to end the week on a high note, but then things suddenly changed after the first hour of trading. Reports of Ukrainian troops attacking Russian convoys spooked investors, and the major stock averages fell sharply. But while worries about a possible Russian invasion pulled down stocks, Treasuries rallied and the yield on the 10-year note fell to its lowest level in a year. By the closing bell, stocks recovered a bit. Here's a rundown of the closing numbers. The Dow lost 50 points, a dramatic rebound from a triple-digit loss earlier in the session. The Nasdaq added 12 points, and the S&P was off a fraction. For the week, all three averages were higher. The Dow rose a fraction, the Nasdaq up 2%, its best weekly gain since May, and the S&P up more than 1%. Over in the bond market, investors turned to safe haven U.S. Treasuries, and the yield on the 10-year fell to 2.34%. Michelle Caruso-Cabrera has more on the latest developments in the Ukraine-Russia conflict.
The markets demonstrated again today that of all the geopolitical concerns out there, the one most worrying to investors is the situation between Russia and Ukraine. And that's because Russia is such a large economy. It's one of the biggest suppliers of energy in the world, and it also has deep trade ties with Western Europe. Every time there is an escalation between Russia and Ukraine, we see the West increase the sanctions against Russia. And while that has hurt the Russian economy as intended, it's also starting to hurt the Western economies, particularly Germany. Already the Chamber of Commerce in Germany has warned that exports to Russia have declined pretty sharply. It's not a huge part of the German economy, but when we've just seen German GDP come out negative, suggesting that perhaps that country is going into recession, it's one of the last things the Western European economy needs at this point. That's why whenever we see a situation like that which erupted today, we see investors run from stocks and instead buy safe haven plays like the Swiss franc and also U.S. Treasuries. It's also why when we've seen Vladimir Putin, the president of Russia, make conciliatory remarks, we've seen the U.S. market rally. It's unclear, though, whether investors are going to continue to believe him if he says those things in the future. For Nightly Business Report, Michelle Caruso-Cabrera.
Well, stocks were not the only investments affected by the escalating conflict in Ukraine. The price of oil, wheat, and other commodities spiked today. Take a look. Oil up nearly $2 a barrel. Wheat prices advanced too, bucking the trend. Gold, which initially moved up but settled at a 10-day low. Jackie DeAngelis has more now on how commodities were impacted by today's unrest in Ukraine.
Crude prices on both sides of the Atlantic reacting to the news out of Russia and Ukraine today of increased tensions. We saw West Texas Intermediate and Brent crude seeing gains of more than 1%. Traders telling me the worry is that if the situation intensifies over the weekend, they won't be able to react to the news. Some traders also suggesting that the market felt too bearish overall and that there was some buying of recent dips. But still, on a relative basis, crude prices on the lower side because of simple oversupply in the marketplace. Remember that global output is up, especially as the U.S. is producing more oil. And despite geopolitics, international output hasn't been impacted. In fact, crude has lost more than 3% in the last month, closing today above $97 a barrel, but well under the $100 a barrel mark. Other commodities impacted by the tensions as well, including gold, which managed to recoup some of its early losses to get back over the $1,300 level at the settle. But gold, typically used as an inflation hedge, didn't move into positive territory due to some headlines from the Minneapolis Fed president saying that inflation will be subdued until 2018. Finally, wheat and corn did spike on geopolitics, gains of 3% and 1% respectively. That's because Ukraine is the world's 5th largest exporter of wheat and 3rd biggest exporter of corn. For Nightly Business Report, I'm Jackie DeAngelis.
So what does all this mean for you and your investments? Joining us now, Jeff Rosenberg. He's Chief Investment Strategist for Fixed Income at BlackRock, and Jeff Sott, Chief Investment Strategist at Raymond James. Welcome to the two Jeffs tonight. Let me begin with Jeff Sott first to get the conversation going. You know, Jeff, a week ago, last Friday, we got those nice comments from Vladimir Putin of Russia, and stock market rallied and stock investors were very happy. This Friday, just the opposite, more money going into bonds. Who's got this right? The people who are putting their money into stocks or bonds as this Russia-Ukraine situation develops?
Well, typically the bond market is smarter than the stock market. In this case, I think it's a flight to safety. The German 10-year bond dropped under a 1% yield. So on a competitive basis, the flow of funds into our treasury market makes sense to me. But the economy is recovering, except for the retail sales that we had this week. And I think stocks are a buy on any dip from here.
Let's go to fixed income, Jeff. Jeff Rosenberg of BlackRock. I think we kind of know why bonds rose in price, down in yield today and in prior days. But let's move the film forward into next week. What do you expect? And specifically, what do you expect out of the Jackson Hole conference where Ms. Yellen and several other central bankers will be?
Well, it's been a general conversation so far talking about bonds and talking about stocks, but what we're not talking about is really which bonds have benefited. And the key here is, historically when investors think about flight to quality, that benefits a shorter maturity bond. This time is very different. What's happening is the flight to quality flows are going into the long end of the yield curve, and that's because we're at zero interest rates, and there's very little upward price movement that can benefit investor portfolios from a flight to quality into the front end of the curve. So the move has been all in the back end of the curve. Now, to answer your question, Tyler, what do we expect next week? Well, certainly it's hard to predict what's going to happen in the Ukraine situation. Any alleviation of that concern, then you're going to see some of this back end, longer maturity move downward in yield come off a little bit as you relieve some of that flight to quality bid that we saw this week. Obviously, that depends on what happens in the geopolitical situation. To your question about Jackson Hole, that's really about expectations for Fed policy, and that impacts shorter maturity bonds. And so that's really about what's the outlook for 2-year, 3-year, 4-year, 5-year type maturities. What I expect next week is for Janet Yellen to reiterate what she has been saying all along, that the labor market recovery is not fully or sufficiently in place for them to begin even contemplating tightening interest rates. You're going to hear a very dovish message from the head of the central bank. Next Friday at 10 a.m. is her scheduled speaking time.
So, Jeff Sott, what do you think about that? I mean, let me ask the question, frame it a little bit differently. If these geopolitical events were not a factor, would we be seeing any of this action with bonds, or is there something going on in the Treasury market and in the U.S. economy that gets so many bond market fans?
I think it's purely a flight to quality. I think it's a competitive yield basis from around the world. You know what the yields are in Japan. You know what happened in Germany. We look pretty good. I'm almost assured of Draghi's statement that he's going to continue, in essence, a quantitative easing policy. I mean, that takes the euro down against the dollar. A strengthening dollar is positive for the U.S. bond market. It's also very positive for U.S. stocks.
Jeff Rosenberg, I want to get in touch with my inner bond geek here without getting too technical. When you describe the idea that long-term interest rates are coming down because that's where the flight to safety is taking it, and you have what's known as a flattening yield curve, that typically signals something endemically wrong in the economy. And when the yield curve inverts, it's usually a sign of a recession. Do you see that?
No, and it's a very good question, Tyler, and it's one, particularly in the context of, stock investors versus bond investors, that's very important for investors to understand about what's different this time when you're seeing that flattening of the yield curve, when the differential between long-term interest rates narrows relative to short-term interest rates. As you just mentioned, typically that's a recessionary sign that's often interpreted as a bad news for the stock markets. Be careful about using that typical interpretation this time. The reason being, you're at zero interest rate policy, and so there's really no room for the front end of the yield curve to go down. So I would say that the flattening of the yield curve that you're seeing today is very different. It's not as negative of a signal as you would typically attach to the bond market signal for equity market investors. It's really about much more the flight to quality issues, what the other Jeff mentioned a minute ago, the relative yield story globally in the low yield environment. 10-year interest rate yields in the U.S. are gaining attractiveness, and that's helping to push their yields lower as well.
All right, gentlemen, thank you very much for joining us on this Friday. Jeff Rosenberg at BlackRock and Jeff Sott at Raymond James.
Well, Monster Beverage had a monstrous day. As we told you last night, Coca-Cola is taking a $2 billion stake in the company to gain a bigger foothold in the hot market for energy drinks. Shares of Monster, the biggest gainer in the S&P 500 today, up 30%. Coke rose nearly 2%. Morgan Brennan has more on the Coke Monster deal and what it could mean for the beverage biz.
Coca-Cola announced it will acquire a 16% stake in energy drink maker Monster Beverage. The multi-pronged deal also includes exclusive distribution and the swapping of certain brands, with Monster receiving almost $2.2 billion in cash. Analysts say this could help Coca-Cola jumpstart its lackluster growth. Sales of soft drinks, 70% of Coke's business, have continued to tumble as more consumers choose healthier drink options over soda.
Between Green Mountain and Monster, what you're seeing is a tacit admission that they need to shift focus.
Earlier this year, Coca-Cola increased its stake in single-serving coffee maker Keurig Green Mountain. But the deal with Monster gives the beverage giant exposure to a fast-growing $27 billion market that attracts a whole new kind of customer. Monster is the energy drink leader, accounting for more than 40% of market share. For its part, Monster will be able to access countries like China and Russia where it doesn't already have a presence. On an investor call today, CEO Rodney Sachs said the move will enable Monster to become a pure-play energy drinks company on a global level. It also turns Sachs and President Hilton Schlossberg into billionaires. But what about the competition?
Pepsi has a partnership with Rockstar, which has been a distant number 3 player to Red Bull and Monster. And so there wasn't really much they could do to catch up other than continue to support that or try other things like Mellow Yellow or other kind of quasi-energy drinks. So I'm not sure that Pepsi will react that much to this one as they would for other type of announcements.
This deal, expected to close by early 2015, does have its risks, most notably increased energy drink regulations, as Monster faces lawsuits tied to its advertising practices and injuries allegedly caused by its products. For Nightly Business Report, I'm Morgan Brennan.
Still ahead on the program, why the once hot restaurant sector, fast casual, is not so appetizing for foodies and investors. Coming up. More trouble for FedEx. The delivery giant is facing new criminal charges, including conspiring to launder money. This is according to an updated indictment from the Justice Department. You may recall that last month, FedEx was indicted for conspiracy to distribute controlled substances by delivering drugs from online pharmacies, which critics say often accept dubious prescriptions. FedEx says it's innocent of all charges.
Shake Shack, the burger and milkshake chain, may be going public. Reuters reports that the upscale fast casual restaurant, which began with one kiosk in a New York City park just a decade ago, is currently preparing its paperwork for an IPO. Shake Shack won't confirm it, but if the IPO is anything like a Shake Shack location, you won't be able to get in.
Well, some other big-name eateries haven't exactly seen the same kind of enthusiasm as Shake Shack lately. That's leaving a lot of diners and investors wondering what's eating the so-called fast casual restaurant industry. Jane Wells has our story.
Americans love to eat, and they've loved eating up just about every new restaurant going public, especially those in the so-called fast casual segment, where sales have been growing double digits.
They basically gobbled all of them up. They wanted to own all of them in the portfolio, and they weren't really taking into account some of the differences, both from the human capital and financial capital aspects of the companies.
And now many investors are going on a diet, shedding shares as some public chains have disappointed. Noodle shares are down over 40% this year, Potbelly about 50%. Even Panera is down about 15%, the pioneer in fast casual. One reason, Americans have a lot of choices.
P.F. Chang's, Cheesecake Factory.
In-N-Out's good quality.
I would say Chipotle, probably. Starbucks.
The lines are blurring on exactly what is fast casual. Now, usually it means higher quality food, fresh, prepared on site, with minimal service at a good price. And everyone from food trucks to fast food giants are saying, hey, we're doing that. Chains like Wendy's are making over stores to look more like Panera or Chipotle. And Taco Bell has just launched a fast casual experiment called U.S. Taco Company. The only clear winner remains Chipotle, which continues to see traffic grow even as it raised prices. Tim Love of the reality show Restaurant Startup says ethnic foods will outperform burgers and fries in terms of sales.
And when you see a restaurant company go public, a lot of times that passion gets dispersed throughout a bunch of people, and you have false money that allows you to expand quicker than maybe you should.
Perhaps the best advice comes from a man who's made a fortune feeding people.
Don't get caught up in the hype. This is food. Take a look what's behind the curtain and see who's actually making the decisions and cooking the food.
Food for thought. For Nightly Business Report, Jane Wells, Los Angeles.
Disappointing earnings from another retailer is where we begin tonight's market focus. Dillard's saw its second quarter profits drop as its margins narrowed. The department store operator blamed increased discounting for the weak performance. Shares slumping, down 8% to $106.11. Possible data breach at SuperValue may have impacted as many as 200 of its grocery and liquor stores. The retailer is investigating the matter and says the breach appears to have taken place from June to July and was possibly the result of malicious software installed by hackers. Shares were down nearly 3% to $9.31.
Deere announced it's laying off more than 600 workers at 4 manufacturing plants. This comes as falling grain prices have hurt demand for Deere tractors and other agricultural machinery. You'll remember on Wednesday, the company announced a drop in third quarter sales and it cut its profit outlook for the full year. So shares were off slightly today to $84.80. And shares of Achillion Pharmaceuticals soared today because its hepatitis C drug performed well in a new study showing no levels of the virus in patients after 4 weeks. The drug was used in combination with Gilead Sciences' Sovaldi drug, which has a 90% success rate, but that drug has been controversial since it costs $1,000 a pill. The stock popped 9.5% to $9.25.
Our market monitor tonight says we are in, quote, a rip-roaring bull market, despite the geopolitical concerns about Ukraine and Russia. He's Marty Leclerc. He's Chief Investment Officer at Barrack Yard Advisors. Marty, welcome. Let's make our audience some money tonight, shall we?
Always up for that.
All right, let's start with your first pick, which is Carlyle Group. Why?
Carlyle is a big global asset management firm. They manage something like $200 billion for some of the biggest pools of capital on the planet, sovereign wealth funds and big pension plans. But they're an alternative asset management firm. And we like Carlyle because pure valuations, and we think it's a growth vehicle. They are the best-in-class operator. Carlyle earns money 3 ways. They get an asset management fee, just like a Templeton or some of the other firms that your viewers might be familiar with. But they also get what's called an incentive fee. It's called carry, where they get to share in the underlying profits of the investments. And then thirdly, what they do is they own some of the investments underlying the portfolio as well. So that's another way they can earn money. Carlyle's trading at around 10 times earnings. The dividend yield is 2%. However, every year, that carry that I mentioned is paid out to shareholders. And last year, it worked out so that as a shareholder at current prices, your dividend yield was like 5.75%. Now, that's not, that's going to fluctuate and that's going to be lumpy, but we think that's very attractive. Finally, it's a 30% discount to its book value of 47.
Okay, all that sounds good. Let's talk about your next one, Aqua America. This is a water firm. WTR is the ticker symbol, which makes a lot of sense. Why should someone buy this at $24.39?
And it also kind of looks expensive because it's trading at 20 times earnings. However, it's averaged higher PE than that over the last 15 years every year. The dividend yield's 2 3/4. But we like Aqua because it's what we would call a predictable growth story. They have their organic business, which is supplying water to consumers in Pennsylvania and other areas. However, the great opportunity is that 85% of the water systems in this country are municipally owned. And the opportunity here, and what they've been taking advantage of for a couple decades, is buying these water systems from municipalities who are starved for cash, buying them really cheaply, and then investing in these systems, making them world-class, and getting a regulated return that's quite attractive. So we think they can grow 8 to 10%, both their dividend and their earnings.
Let's move to your third choice, which is a little company not many people would have heard of, Marty.
Yeah, IBM is much maligned. It's perceived as a no-growth story, notwithstanding the fact that their earnings have compounded by 13% over the past 5 years and 14% over the last 10 years. This selling cheap, 10 times earning, 9% free cash flow yield, which gives them a lot of money to be able to reinvest in their business, but also to pay out a dividend and buy back more stock to continue to shrink the share count. What IBM's not given credit for is that it's one of the most innovative companies on the planet. Over the past couple of decades, every year they're either number 1 or number 2 in terms of the number of patents awarded to them by the U.S. Patent Office. So we love IBM for
let's get
being
to
a cheap value
disclosures.
stock.
Do you or your family members own any of these companies personally or in funds?
I own all 3 of them personally, as do my clients and family members.
Thank you very much, Marty. Appreciate you being with us. Have a great weekend. Marty
My
LaCour
pleasure.
At Barrack Yard Advisors. And coming up, Beyond Stocks, a look inside the revved up market for collectible cars.
If your taste in cars runs high, as in spending millions to acquire rare or antique autos, then this week's annual Pebble Beach Classic Car Auction is just for you. But are prices too high, and could there be a bubble brewing in the collectible car market? Robert Frank has the story.
At 34,650 then, selling the car, are you all finished? No more. Last chance. You own the car.
Fast and furious. Prices for collectible cars hitting all-time highs and raising questions about whether we're seeing a new bubble forming in vintage Ferraris and other classic sports cars. Last night, this Ferrari became the most expensive car ever sold at auction, selling for $38 million, including auction fees.
And when you buy a GTO, you also gain access to the most exclusive auto club in the world, only 36 owners. And if you don't want to spend your $50 million to join, you could always get one of these, a GTO replica, which will only cost you $50,000.
Now, the Ferrari kicked off 4 days of sales here at Pebble Beach, which is the Woodstock for rich car collectors. Between $450 and $500 million worth of cars expected to be sold, up from $300 million last year. The auction companies say this boom will keep on going because cars are scarce and the world is creating more millionaire and billionaire car collectors.
Car market is at an all-time high, but I don't believe it to be a bubble at all. It's not the entire car market that prices have risen. It are just certain sectors of the car market. I think it's just the beginning for the very, very upper echelon of automobiles.
Jay Leno, the comedian and car collector himself, says that the collecting world is now diversified.
The rumor is there's a guy in Saudi Arabia who buys every DB5. Aston Martin, and he's got like 212 of them. So whenever they come up, he buys them.
And that's just his DB5 collection.
Yeah, exactly. I mean, so Americans used to have all the money. You know, the guy from Texas with the big cigar. But that's been replaced by the Chinese and by Saudi Arabia, so it's a little different. You've got to compete on a world market instead of just a local market.
But there are some warning signs flashing on the dashboard of this market. Dealers and speculators are starting to pour in and flip cars for multi-million-dollar profits in just a year or two. And lots of buyers are new. New money is not always the smartest money. But at least for this weekend, it looks like the collectible car boom will keep on rolling. For Nightly Business Report, I'm Robert Frank in Pebble Beach, California.
Real works of art. Beautiful,
Pretty
beautiful, beautiful. That's Nightly Business Report for tonight. I'm Susie Garob, and we want to remind you this is the time of year your public television station seeks your support.
And I'm Tyler Matheson. On behalf of your public TV station, thank you for your support. We'll see you back here Monday. Have a nice weekend.
I'm Susie Garob with a Nightly Business Report news brief. Reports of Ukrainian troops attacking Russian military convoys spooked investors, sending U.S. markets tumbling, oil spiking higher, and the yield on the 10-year Treasury note falling to a one-year low. But by the closing bell, stocks recovered much of those losses. The Dow lost 50 points, erasing an early triple-digit loss. The Nasdaq added 12 points, wrapping up its best week since May, and the S&P off a fraction. Shares of Monster Beverage shot up more than 30%, the biggest gainer in the S&P today, a day after Coke invested $2 billion in the energy drink maker. And FedEx is facing new criminal charges, including money laundering related to making deliveries of drugs from online pharmacies outside the U.S. Be sure to tune into Nightly Business Report right here on your public television station.